Hi everyone, my name is Robin Speziale and I am the national best-selling author of a book called Market Masters, Interviews with Canada's Top Investors. In this video, I'll be talking about Jason Donville, who owns Donville Kent Asset Management. It's a hedge fund located here in Toronto, in which I live. I interviewed Jason Donville for my book Market Masters, and you can find that full interview in my book. And you'll see all of his investing strategies, the big winners he's had over the years, some of his losers, and his advice to do-it-yourself investors. But if you go to Jason Donville's website on Donville Kent Asset Management, you'll find Mr. Donville's investment philosophy and his investment process for picking stocks and taking on positions in his hedge fund. And I think the points he makes here are pretty important. I'm going to read them directly from his website. So let's start with his investment philosophy. Jason Donville says, "We believe that superior long-term investment returns can be achieved by focusing on companies that consistently earn high return on equity, ROE, while possessing some form of competitive advantage that can be sustained on a multi-year basis. A competitive advantage is typically achieved by the existence of 1, a barrier to entry into the industry, 2, a superior product or service that cannot easily be copied, 3, a superior physical location. Once we've identified a company with an attractive competitive advantage, we then look to acquire shares at a price we deem reasonable in relation to our assessments of future cash flows of the business. In summary, we attempt to buy outstanding businesses at a reasonable price, rather than inferior businesses with low relative valuations." So right there, you know that Jason Donville is definitely a follower of Warren Buffett. Not only that though, but he's a growth investor, and he's not buying, quote unquote, value stocks just because they have low valuations. Because as we know, value stocks can get cheaper and cheaper and cheaper. Investment process. So here Jason says that he starts with idea screening. He says, "Our first step is to screen Canadian public markets for stocks that are currently earning higher returns than common equity, typically in excess of 20% ROE at a minimum. Basic screens, ongoing communication with our global network of industry contacts, industry publications, and financial media are all potential sources of new ideas." He also says, part of his investment process and stock picking strategy is his proprietary database ranking system. Jason Donville says, "Once we have identified a company that meets our initial criteria, we have several adjustments to company and analyst earnings forecast in order to take into account non-cash items. Subsequent to those adjustments being made," he says, "we enter the relevant data into our proprietary database, where each company's return on equity, valuation, and share price momentum are scored in relation to all other stocks in our universe." Then he talks about analytics. Jason Donville says, "Those stocks then that achieve the highest aggregate scores in our database are then subject to comprehensive quantitative analysis, which includes extensive earnings modeling as well as scenario analysis." And finally, Jason says, as part of his stock picking process, is a management evaluation. "Our final step," Jason says, "involves face-to-face meetings with company management, channel checks, and discussions with industry analysts. If this process is successful, the position is added to the portfolio, constantly monitored quarter after quarter, and actively traded." So to summarize Jason Donville's investment philosophy and process, again, Jason Donville told this to me in his interview. He said that as soon as he read the book Buffettology and just learned more about Warren Buffett and his own process, he focuses completely on companies that can achieve a high return on equity. And Jason Donville says that combined with a high rate of growth of earnings per share, free cash flow per share, and book value per share, along with that high return on equity over a period of 5 to 7 plus years, those types of stocks will just jump out at you. And one of the best resources I find for stock analysis is Morningstar. If you go to morningstar.ca, and for example, you type in let's take the example of Lassonde Industries, which makes juices. type in Lassonde, and then there's a tab there called Key Ratios on Morningstar.ca. You can see a 10-year table of all the key metrics for any company, including Lassonde as our example. And from there, good companies will literally just jump out at you because you see an amazing trend line up for, again, all these important per share metrics like earnings per share, free cash flow per share, book value per share, and then other things that are very important like gross margin, maintenance of that or an increase in gross margin over time, and return on equity and return on capital, a sustainable metric over time. All right, guys, I hope you enjoyed this video. If you have any questions, you can email me at r.speziale@gmail.com or check out my website for more write-ups on investing at robinspeziale.com. Thanks.